Well, we set out a broad plan in 2018 to step on the gas on a number of areas. I think importantly, we're going to double the number of new hotel properties in 2018 that we added in 2017. And of course, this is an important part of the formula. Over the course of the last 5 years, we've built up a real muscle around adding new properties that gives our customers more selection and builds incredibly powerful network effects. We've got a disciplined track record of making calculated investments. This is one of those, and we're confident it's going to accelerate our growth over the long term.
Although people do seem concerned about the pace of costs and expenses at this point, what kind of assurances can you give them, particularly given the reception you're getting in the stock market today, that you are going to be able to have sales growth outpace the costs of getting those sales?
Well, I think you've got to look really closely at the source of the cost increases. And really there are two things here. First of all, it's our migration of our data centers into the cloud computing environment. That's already free cash flow accretive. 2 years ago, we spent $180 million on capital expenditures into the data center. Last year was about $50 million. So you've seen a $130 million drop in CapEx, and last year our cloud spend was about 95. So already free cash flow accretive. We're going to continue to make those smart free cash flow investments in 2018. It puts pressure on the P&L, but it's absolutely the right thing to do. And then, of course, the supply investments. And the supply investments, this is not a new big bet. We've done this for the course of the last 4 years. It's been incredibly successful. We see the returns. We are making more of the same investments. So we feel really confident in the returns of what we're doing. And we think if people really look into the drivers of the costs, they'll share our optimism.
Mark, you're talking about adding more hotels, more properties to the mix here, but I'm also seeing upcoming contract renewals with the large hotels, be it Marriott, maybe Hilton, that the expectation is they're going to ask for lower commissions, a more cost-effective fee structure. That doesn't sound like it's necessarily that great for business. Can you elaborate?
Yeah, listen, we've got very constructive dialogues with all of our large chain partners, and they really do see the value of the platform. And the direction that we've been going with the recent renegotiations is actually just being much more flexible in the way that we do business with our hotel partners. We've got a number of contracts in place where we give hoteliers the flexibility to give either their own revenue management centers or their individual hotels the ability to bid more, to get more volume when they need it. The ability to spend more on our advertising products, again, to get more volume when they need it. So I think what you're going to see over the course of the next 5 years is just much more intelligent marketplace type pricing. We've got it in place right now with many of our more forward-thinking hotel partners, including the big ones. And that's the direction. I think it's created a much more constructive dialogue for us, and we are comfortable with the relationship.
Well, Mark, what do these initiatives, both those and the investing in new properties, say about the moment we're at in the lodging cycle, for example? It seems as if just in general, your business maybe is not on, doesn't have as much leverage as at other points in the cycle, and is that something that might continue?
Well, you know, I think the lodging cycle has been at a pretty hot spot for a long period of time, but, you know, we take a different perspective on our opportunity. I mean, we are not just sitting here in the United States as that is our only opportunity. We look out into the market, we see a market that's $1.6 trillion. We just did under $90 billion of bookings last year. We see over 1 million hotel properties and multiple millions of alternative accommodations out there. We've got 590,000 alternative accommodations and hotel properties on our core OTA platform. We see a world of opportunity ahead of us, and we are dead focused on executing on that. 2018 is going to be the start of us really getting serious about expanding into that opportunity, and we think there's lots of opportunity ahead.
But you did say on the call, you know, the real benefit to adding supply comes in the second year and in subsequent years when you can really see the full year impact of the properties you've added. But you did go on to say you hope to see that in 2019. But at this point, there's no guarantees. I guess investors would love some guarantees from you, Mark.
Investors always love guarantees. But you listen, I think the essence of this is that we know the returns will come. We've seen it happen in practice. And the question is, when you see accelerating room night growth, when you see accelerating revenue growth, I think at the end of 2018, we're going to have a question that we have to answer, which is, do we let that goodness fall to the bottom line? Or do we propagate the cycle again, invest more into new geographies, and keep it going? And I think that's just a decision we haven't made right now, but we have no question that returns will come.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.